Hi everyone, welcome to Ask a Property Manager episode number 81. Today is July 28th, 2021, and we're coming to you from Studio 2.0 here at Own Buffalo. I'm Andrew Schultz, Principal Broker of Own Buffalo Inc., and on today's show we're going to be talking about international investors buying rental property, what to do when your tenant breaks the lease. We're going to talk about the pros and cons of single versus multifamily investing. We'll answer some questions from housing providers around the country and so much more. We got a big show for you here today. We're going to go ahead and jump right in by plugging our social media. New episodes of Ask a Property Manager every Wednesday, 10 a.m. Eastern. You can catch those live on Facebook. You can also catch the replay on Facebook or over at our YouTube. Don't forget about our Instagram. We post content there that doesn't make it to the other two platforms. And last but not least, we are about to drop another episode of the Rent Prep for Landlords podcast tomorrow morning. This week, we are taking a look at co-signers for college student rentals. What obligation does a landlord have for a tenant's mail after they've moved? And what to look for when hiring a property manager. So that's a pretty good episode as well. Don't miss out on that. New episodes of the podcast drop every other Thursday. Next episode drops tomorrow morning. And that can be heard over at rentprep.com/podcast or anywhere podcasts are heard. We're going to go ahead and jump into our news of the day here, starting with this article from CNBC. International buyers dropped out of the U.S. housing market during the pandemic, but China is rushing back. U.S. home buyers went on a buying spree during much of the coronavirus pandemic's first year. International buyers did just the opposite, though. Even with virtual options in place for property tours, sales of U.S. homes to foreign buyers fell by 31% from April 2020 to March 2021, according to the National Association of Realtors. International buyers purchased 107,000 properties, marking the lowest unit volume and lowest dollar volume since 2011. The biggest decline in foreign purchases of U.S. homes in the past year is no surprise, given the pandemic-induced lockdowns and international travel restrictions, said Lawrence Yun, NAR's chief economist. Yet even with the absence of foreign buyers, the U.S. housing market strengthened solidly. China, Canada, India, Mexico, and the United Kingdom were the top 5 countries in sales dollar volume for U.S. residential properties. That dollar volume, however, was down at least 50% for buyers from China, Canada, and Mexico. The UK was the only country among those 5 to see an increase from the year before. Chinese buyers are particularly important to watch as China has taken over as a lead demand for U.S. housing in the early part of the last decade, but then fell back slightly during the Trump administration. Now Chinese buyers are apparently surging back in. There's been quite a positive impact on the demand from the Biden boost, as the U.S. is being perceived as much more predictable now, and visas are also much easier to be obtained, said George Chimel, executive chairman of Juwaya IQI, a home listing site in China, much like Zillow in the United States. On the other side, now that we are over a year dealing with the COVID pandemic, it has lessened the impact on the buying decisions because flights to the U.S. are now possible. Home prices are now about 15% higher than they were pre-pandemic, but that may actually incentivize for international buyers. Rising prices create demand because people start to fear that they're missing out. International buyers still believe that the U.S. is a good investment because global comparison homes are still quite affordable. Is a good investment because by global comparison, homes are still quite affordable. Now that sentence makes sense. Looking at properties by square foot, U.S. homes are much more expensive than homes in Hong Kong or London, for example. International buyers, as well as everyone else, are also far more comfortable now with virtual home buying. The number of virtual tours has increased dramatically across all real estate platforms, both in the United States and abroad. Juwaya reports having 5,000 virtual tours available and being used right now. So if that's an indication of the comfort, then certainly this has increased because people are now used to doing far more things online, shopping, education, working, etc., and that has also had an impact on the property market. The top destinations for international buyers have not changed much despite the pandemic. For the 13th straight year, Florida was in the lead with 21% of all international purchases. California ranked second at 16%, followed by Texas 9%, Arizona 5%, and New Jersey and New York tied at 4%. International buyers continue to be driven by high potential returns on investments, as well as seeing the U.S. as a safe haven for cash. More recently, Chinese buyers especially have purchased homes for children, hoping to take advantage of higher education opportunities in the U.S. As travel restrictions loosen and foreign students return to U.S. colleges in the upcoming year, there's likely to be some growth in foreign buying of U.S. real estate, Yoon said. High home prices and the ongoing lack of inventory could, however, pose a challenge for buyers. So I wanted to touch on this article. We talk about different types of investor pools and things like that. And international buyers are critical to American infrastructure, real estate infrastructure, whether people realize it or not. We work with a lot of investors here in our office, both local, national, and international. And I can tell you that without the international investment here at least here in the city of Buffalo, we would not see some of the development that we have seen. Yes, a lot of the local projects have a local name tied to them, the bigger projects. For instance, the HSBC Tower, the Seneca One Tower, is being tackled by Douglas Jamal from Washington, D.C., a United States resident. On the back end of that, there's a chance that there's, financing that comes from outside the country. So it doesn't necessarily need to be direct asset ownership. It could literally be providing the financing for some of these projects to make them go. The point is, international investment in the United States real estate market is critical at all levels. It doesn't matter if it's somebody coming in and they want to start doing fix and flips, or if they want to come in and start building a buy and hold portfolio of smaller properties and then graduate up to bigger stuff. No matter how you slice it, having those international dollars here in the United States means a lot when it comes to the investment market here. And missing out on international buyers would be a real tragedy. So I'm glad to see that international buyers are starting to come back. I understand that we have inventory pinches and things like that right now. That is going to create an issue. The article even stated it's going to create an issue when people start trying to buy and trying to compete against these people. But I would rather see, small scale international investment, one or two investors coming in to buy some properties here in the United States, versus some of the other international investment projects that we're seeing where, for instance, China will build an infrastructure project in a country that can't afford to pay for it, and then turn around and when they default on the loan, inevitably, China turns around and says, okay, well, this piece of your national infrastructure now belongs to us. And I'm really oversimplifying things there. There's a lot more depth to that than what I'm just scratching the surface on. But I would much rather see individual investment than national investment, I guess is what I'm saying. I would rather see individuals investing in real estate here rather than seeing the countries themselves try to purchase property here or create a group to buy property here. So it's good to see. I hope it continues. I hope it continues on the right path. That's what's going to be critical here. It's definitely something to monitor as we move forward, but I am glad to see that the international buyers are coming back around. Next article, this one comes to us via the World Property Journal. Single-family rent growth rate spikes in May. This was published just yesterday, July 27th, so we're actually looking at data from the month of May, but the article itself is current. Data company CoreLogic's latest May 2021 single-family rent index for the United States shows a national rent increase of 6.6% year over year, up from a 1.7% increase year over year in May 2020. The shift in consumer preferences towards lower density communities and single-family shelter continues to cause a ripple effect in the rental market, with single-family rent growth reaching the highest level since at least January 2005 in May. Due to high purchase prices and ongoing limited availability of for-sale homes, would-be first-time buyers are opting to remain renters instead of entering the housing market. However, similar inventory and affordability challenges are also emerging in the rental space. For the first quarter of 2021, the U.S. Census Bureau reported that single-family rentals averaged 94.5% occupancy, up from 93.7% 1 year earlier, which has continued to drive up rent prices. Single-family rents rose by nearly 4 times the rate from a year earlier in May 2021, said Molly Bozel, a principal economist at CoreLogic. Strong job and income growth, as well as fierce competition for sale housing, is fueling demand for single-family rentals. Looking ahead, these market forces are expected to remain for much of the year and keep rent increases high, particularly in urban areas and tech hubs, as more people return to working in person. Among the 20 metro areas shown in Table 1, Phoenix has the highest year-over-year increase in single-family rents, with in May 2021 at 14%. Tucson, Arizona had the second highest rent price growth with a gain of 11.1. Some tourist destinations that were hit hard by the pandemic are also showing strong signs of recovery, with Las Vegas logging the third highest year-over-year rent growth of 10.7%, while Boston has experienced the largest decrease in 20 metros rent prices for 11 consecutive months now, with an annual decline of 4.5% in May. The area's rate of decline is slowing compared to previous months. To gain a detailed view of single-family rent prices, CoreLogic examined 4 tiers of rental prices. National single-family rent growth across the 4 tiers and the year-over-year changes were as follows. Low tier, 4.6%, up from 2.7%. Lower middle tier, 5.8%, up from 2.0%. Higher middle priced, 6.2%, up from 1.7%. And higher priced, 7.9%, up from 1.3% in May 2020. So rents are going up. That is, I don't think, a real shock to anybody. It's interesting to actually see some numbers put to it so we understand what it truly looks like when we're talking about what are these increases and things of that nature. What are we talking about in terms of the actual growth or shrinking? I mean, last year, I believe we were talking about a few markets where the rents had dropped. And now it seems that that has kind of reversed course and is starting to come back around, which is a good sign for everybody. Also keep in mind, we're only looking at single family here. So if you're talking about a market like New York City, where most everything is going to be multifamily, that's not taken into account in these statistics. We're only talking about single family residential, which tends to, especially when you're talking like larger markets, Los Angeles, New York City, things with high rises, etc. There's not as much single family on the market there as what there is multifamily. So understand the stats that you're looking at are strictly single family rent growth, not multifamily. There may still be struggling issues in the multifamily realm in some of those areas, but single family is starting to perform better. All right, let's look at some funny stuff. I think that I've had this saved for a few weeks now. I don't remember where I pulled it up from, but yeah, I've definitely seen some guys that have tried to pull jobs like this. And this is what happens when you say the price is too high and they found someone cheaper. That's the quality of the job that you get. It's unfortunate, but that's kind of what you wind up with. Just a reminder, if you're choosing a contractor, always choose someone that has insurance and always make sure that you get everything in writing. 2 very, very critical things. I don't know if you hired this guy to do your landscaping, but I would certainly tell him that he's fired. Yeah, that's definitely not the way to clear an obstruction in a brush chipper. That's insane. That's a real good way to wind up with a peg leg. I guess the only positive here is he's got some tree branches that he could strap onto his leg when he eventually does remove most of his right leg there. So at least he can hobble to the hospital that way. All right, let's go ahead and get into our questions from housing providers around the country here. Starting with this one on tenant damages, repair or replace. Hey all, what are your thoughts on this? Long-term tenant has an older front door with 4 single-pane windows. The tenant broke one of the windows. I'll have to put a new pre-hung entry door in place because the window can't be replaced. Should the tenant pay for the whole replacement or some part of it? I'm leaning towards tenant paying 75% of the full replacement cost, door plus labor. What are your thoughts? Thanks in advance. It's very weird to me that you can't get the glass replaced on this door. Glass companies can cut a piece of glass to whatever size you need it to be. They can frost it, they can shade it, they can vacuum seal it, they can argon gas it, whatever you need. Glass companies are set up to be able to do this type of thing. I think installing a new door is probably unnecessary in this set of circumstances. I don't have all the info, obviously, but it just seems to me like you should be able to get the glass replaced here. That said, the tenant did cause a damage, so the tenant is responsible for some portion of the cost. If you are not going to, if you're going to replace the entire door, you can't charge them for the entire door cost here, in my opinion. You could charge them for the cost of the glass replacement. I think that would be a fair charge, but charging a tenant for a brand new door when all they've done is break the glass and that component can be replaced, that is pushing the limits, I think. I don't think that that would be a wise move on your part. You're not going to be able to charge them for the whole door here, I don't think. You're going to have to charge them for just the cost of what it is that they broke. That said, the tenant did cause the damage, so the tenant is responsible for the cost of that repair. If you want to replace the door anyway, my recommendation would be go ahead, replace the door, and charge the tenant for the broken glass in the previous door. I'm wondering if that might be the case here, is you're just trying to get the door replaced on somebody else's dime. Don't do it. do it the right way, charge the tenant for what they rightfully should be charged for, and if you're going to replace the door, you're going to wind up eating some of that cost. You could also sit and look at this from the perspective of, okay, what's the useful life of a door span, useful lifespan of a door, and break it out that way if you wanted to go that route. I don't necessarily think that it's required here. I think that you can come up with a better solution, but that would be my recommendation, would be fix the door. There should be no reason why you can't get a new piece of glass thrown in that door. Next question, tenant breaking lease. My tenant's lease expires 8/14. On 6/24, we signed a new 1-year lease. Today she texted me saying what a great landlord I've been and that she loves the house, but that she found another place and that she's moving out. With regards to the new lease that was signed, I understand how inconvenient this may be on your end. I'm willing to show the property and try to get someone approved by a mid-August move-in. It doesn't seem like she thinks that she's responsible for the 1-year lease, which starts on 8/15, until we find a qualified tenant. She also only gave me 2 weeks notice. The lease has a 2-month notice. Any thoughts? So this tenant is moving and you're not going to stop them. So you might as well get that understanding through your head right away. The events are already taking place. You are now a part of the events. This tenant's not going to not move simply because you tell them that they're responsible for this apartment until a new tenant is secured. This is now a damage mitigation issue. Start marketing the apartment as soon as possible. Let the tenant know that they're responsible for the rent and the utilities until such time that a new tenant is placed. Also let them know that security deposit cannot be used towards that rent or towards those utilities, because the security deposit is to cover any damages that are found after the tenant moves out when you're doing this transition from the existing tenant to the new tenant. The new tenant states that, or the existing tenant does say that they want to help you show the property. That's great news. That makes life a lot easier. If the tenant's going to be available to allow for showings and stuff like that, they may even be able to list the apartment for rent themselves and help bring in leads or something along those lines. That's a good outcome. Realistically, if the tenant pays the rent here and continues to pay the utilities and leaves the place clean for you, that's a good outcome. The worst case scenario here is the tenant just disappears and says, take my security deposit and I'm gone. Then you're going to have to sit and pursue them in court and everything else, which is a whole nother adventure. But realistically speaking, if they follow the rules and at least continue to pay the rent and utilities until a new tenant is placed, you're not really out financially a huge amount. Time-wise, you're going to be out some. But hopefully that's you're able to place a new tenant prior to this new lease starting. You've got a couple weeks here before the new lease starts. You may be able to find a new tenant and get them secured prior to the start of that new lease. But if not, that outgoing tenant is still going to be responsible for the rent and the utilities until that new tenant is found and placed. This is a good time to read up on your lease. Take a look and see what your lease says regarding lease termination. Do you have something in there regarding, the tenant has to give so much notice and pay a fee, or they can't break the lease, or they can or cannot sublet, whatever the case may be? It's a good time to take a look at your lease, see what it talks about, or see what your lease says when it comes to lease termination, a lease break fee, and the possibility of subletting. Those are 3 things that you want to look at when you're talking about broken leases and things like that, to see what your options are when it comes to dealing with that outgoing tenant. Also keep in mind, if you are a housing provider here in the state of New York, as of summer 2019, when HSTPA went into place, you now have a duty to try to refill that unit as per the legislative updates. So it's not like you can just sit there and not market the place for rent and not show the place and continue to collect rent from the outgoing tenant. You have to make the effort to find a new tenant for that space. On to our next question. Actually, this will be our last question. Single or multifamily investing? Small single family houses or multifamily? Which do you prefer to invest in and why? My preference is multifamily. The main reason being, when a single family property is empty, it's generating 0 revenue. When half of a duplex is empty, you still have revenue coming through the doors. When 1 unit in a 4 unit is vacant, you have 75% of your revenue coming through the doors. When 1 unit out of a 20 unit is vacant, you get the idea. The more units, the easier it is to absorb costs, essentially, is what I'm saying here. Whether that cost be vacancy, whether that cost be maintenance, whether that cost be management, insurance, taxes, the larger the number of doors you have under management or under ownership, under your control, essentially, the easier it is to have a vacancy. If you're going to have 20 single families, that might work. But if you have one single family, that's a risky scenario. I understand that there are a lot of accidental landlords out there that may only have one single family asset, and you have to manage that asset however you see fit. But having one single family asset is, in my opinion, a high risk scenario for any investor. That being said, this is also going to vary quite a bit based on your market. For instance, here in Buffalo, we have a lot of 2 to 4 unit multifamily in the city. Then when you get out into the, the first and second ring suburbs, it starts to go more apartment complexes in like the first ring, and then single family in the first ring. And then once you get out to like second ring, it's typically more single family residential and things like that. So it's going to depend on what your market makeup is as to what you're going to be investing in. It's also going to depend on price point. If you can't buy a 4 unit for under $500,000, well, then maybe a 4 unit's not the first thing that you're going to buy. Maybe you have to ease in with that single family, buy a couple of single families and then 1031 exchange into a 4 unit down the road when you're at that point. You have options. I'm not saying you have to jump into multifamily right away. I'm just saying that my preference is always a multifamily over a single family. So there are some cons to multifamily. You do have a lot more neighbor issues, tenant-to-tenant disputes in multifamily than what you typically would in a single family. You're generally going to have more neighbor issues with multifamily versus single family for that same reason. But from a financing perspective, multifamily is definitely the way to go. And the reason I say that is because you can put up to 4 units on one mortgage. So if you buy a 4 unit building, that's one mortgage, and it's considered a residential mortgage. So it's a lot more bang for your buck, if you will, buying a multifamily, even a duplex, than a single family. Lots and lots and lots of reasons to consider multi over single, but they are 2 very different beasts when it comes to ownership and when it comes to management. So that is definitely something to keep in mind. What are your preferences on investment? Do you prefer singles or multis? I'm kind of curious. Drop a comment down below. Let us know what you think is the better option, single or multi, and why. I'm actually curious to know what everybody likes to invest in and what for what purpose. So that pretty much wraps things up for this week's episode. That was our final question, so we're going to wrap things up here. Thank you all so much for watching. I love producing Ask a Property Manager, and you can help us to improve by dropping a question in the comments either on Facebook or on YouTube, and your question may be picked up and answered in an upcoming episode. If you enjoyed this content, or if I brought some value to your day, do me a favor and hit that thumbs up button. YouTube and Facebook both push videos based on community feedback, so every like, comment, subscribe, and share helps us to grow and reach more people. We'll be back next week on Wednesday, August 4th with an all-new episode you won't want to miss. Until then, thank you all so much for watching, and we'll see you next week.